Hey everyone, Dan Longman here with Priority Lending. Happy Saturday. Hey, so I wanted to give you guys a quick update as far as the market. So yesterday, we had a big jobs report that was released. This was the February jobs report. Now, you may recall in January, the jobs report was released, and the expectation was the job creation to be around just under 200,000 jobs. Well, the BLS jobs report came out, and it was over 500,000 jobs added. So, huge increase. It sent the markets spiraling actually downward. And the reason of this, when you have excessive job creation when we're in an environment right now with high inflation, is what the Fed thinks is more jobs created, more money people are going to spend, and therefore the price of goods continue to go up. So everyone has been waiting for this February jobs report to come out. The initial estimates were that we were going to have about 225,000 jobs created. Well, once again, it beat the estimate. It was just over 300,000, 311. But the markets weren't rattled too much by this. At least wasn't the excessive increase that we saw in January. But I do want to show you a chart here in a little bit because the job market, the excessive gains that we're having have to do with one sector really, or one, I should say, one major sector is contributing to a lot of these job gains. So I'm going to share my screen with you here, and I want to go through this report real quick. So there were, despite the gains, despite the 311,000 jobs added, there were some cracks in the jobs report that I want to show you here. So we're going to start with the weekly hours. So the weekly hours went actually down from 34.6 to 34.5. I know that seems very minor, but that's actually a pretty big deal, and that's starting to show that maybe the job market is losing some steam here. The average hourly earnings were up 0.2 month over month. So this is the smallest gain in a year. Once again, maybe some momentum is slowing down here. And the average weekly earnings were down 0.05 a month over month. So, but the biggest thing to look here, what I wanted to show you is the gain in jobs in the leisure and hospitality sector. So if we go to this map down here, you're going to see this is charting it over basically the last 10 years. You can see we kind of had a steady incline, right? From 2013 all the way until COVID hit. Kind of remained flat, just a slight gain. You look here, when COVID hit, it basically fell off the map. We had a huge decline in the hospitality and leisure industry. I mean, if you knew anyone in the restaurant, hotel industry, they were massively impacted by this. But since then, we've had a steady gain. I mean, a little dip here. This could have been, a COVID outbreak at the beginning of 2021. But other than that, we've had a steady gain here. But the job adding over these last 2 years, if you look how quickly it's jumped up, that's where a lot of the gain has come from in these jobs report. But as you can see, it's starting to level off now, right? It's starting to kind of plateau here, and we'll probably kind of go along this even line like it's been. So as a result of that, we believe that these massive job gains that you've seen are now going to start to settle, and you're going to start to see the hourly amount worked go down, and maybe the income go down. Now, listen, it's a terrible thing to say that we're not necessarily rooting for a bad job market or for unemployment to go up. We're just hoping that it calms down, because the reality is that's what the Fed is looking at. Like I mentioned earlier, the Fed wants to see the economy slow down, and I feel like they'll do it at all costs, to try to get inflation lower. So to see the job market start to slow, we don't want it to see it to completely, crumble and we have massive unemployment. But we do need a slowdown here, because we need the Fed to be happy and taper back on their rate hiking, because the reality is short-term rate hikes really affect everybody, but especially the middle and lower class. I mean, everything you purchase, whether it's going out to purchase a car, your credit cards, these higher rates are really, really impacting folks. And also businesses, businesses borrow a lot of money to purchase product, whether it's their inventory, they have credit lines. So they can only withstand these high rates for so long. So that's why it's important that we get inflation under control. Therefore, the Fed will hopefully stop hiking first. We want to stop the bleeding and then eventually lower it. So anyway, just wanted to give you a quick update as far as what is going on in the market. If there's anything we can do for you guys, feel free to reach out. We're here to help. Other than that, I just hope you have a great weekend and talk to you soon. Take care. Bye bye.